Everyone knows crypto is volatile. That's the risk people talk about. You put money in, the number goes down, and some of it doesn't come back. But there's a second risk almost nobody talks about, and for the last decade or so, it has quietly shaped everything about this market. America never actually wrote the rules. Not in the sense that crypto was some lawless frontier. In the sense that the rules existed, sort of, scattered across laws written in 1933 and 1934, and the only reliable way to find out whether you'd broken one was to get sued for it. That happened to Coinbase. It happened to Binance. It happened to Ripple and Kraken and dozens of companies you've never heard of. Imagine a motorway with no speed limit signs anywhere. You drive it every day. Then one morning a letter arrives telling you that 3 years ago on a Tuesday you were going too fast. That is what building a crypto company in America has felt like. And now, for the first time, there's a bill that would fix it. It runs to 594 pages. It passed the House of Representatives 294 votes to 134, with more than 70 Democrats crossing the aisle. The strongest bipartisan endorsement any digital asset legislation has ever received in American history. It could unlock institutional money that has been sitting on the sidelines for years. It's called the Digital Asset Market Clarity Act, and it has spent the last year stuck. Ask most people what's wrong with crypto regulation, and you'll get some version of the same answer. It's unregulated. It's the Wild West. Nobody's in charge. That was never true. The problem was the opposite. Crypto in America wasn't unregulated. It was regulated by lawsuit. Here's how that worked in practice. The Securities and Exchange Commission took the position that most tokens were securities, which meant they fell under laws written in 1933 and 1934, back when a security meant a share certificate in a filing cabinet. When crypto companies asked the SEC how to comply, the answer was register. When they asked how to register, there was no answer, because no registration pathway existed that was designed for a digital asset. So companies made a judgment call, launched anyway, and waited to find out whether they'd guessed right. Sometimes they found out 4 or 5 years later in a courtroom from a lawyer. That's not the Wild West. The Wild West at least tells you where the sheriff is. The Clarity Act has one central job, and it sounds almost boring when you say it out loud. It decides which government agency is in charge of which crypto asset. That's it. That's the whole fight. For a decade, two agencies have both claimed authority over the same market. The SEC regulates securities, stocks, bonds, investment products. The CFTC regulates commodities, oil, wheat, gold, and the futures markets built on top of them. Crypto arrived and didn't fit cleanly into either box. So both agencies reached for it, and the industry got caught in the middle. And that wasn't a polite disagreement. The same token could be a commodity to one arm of the government and a security to another at the same time, with different rules and different penalties attached to each answer. Exchanges had to guess which view would win and build their businesses around the guess. The Clarity Act sorts every digital asset into one of 3 legal categories. The first is digital commodities. These go to the CFTC, which would get exclusive jurisdiction over their spot markets for the first time in its history. Bitcoin is the obvious example. Ethereum is the other. The second is investment contract assets. These stay with the SEC. Tokens sold to raise money for a project a central team promises to build. If you're funding somebody's plan, that's a securities question. The third is payment stablecoins, which get their own category under joint SEC and CFTC oversight, sitting outside both regimes entirely. But here's the part that most explanations skip, and it's the most important detail in the entire bill. The test isn't what kind of asset you are. The test is how decentralized you've become. A token qualifies as a digital commodity only once its underlying blockchain is certified as sufficiently mature, meaning no single person or group holds unilateral control and the network actually functions on its own. There are tens of thousands of tokens in existence. The vast majority of them, particularly newer and smaller projects, would not qualify straight away. They'd stay under the SEC, but they could graduate. A token that starts life as an investment contract asset can move into commodity status later, once its network genuinely decentralizes. Think of it less like a label stuck on a jar and more like a driving license. You start on a provisional and you earn your way off it. That's a genuinely new idea in American financial law, a legal category you grow out of. On top of the sorting, the bill sets registration and operational rules for exchanges, brokers, and dealers, and includes protections for developers who write code but never touch anyone's money. So why does a bureaucratic filing question have people talking about trillions of dollars? Because of one thing, custody. There's an assumption that big institutions avoided crypto because they think it's a scam or too volatile. For some, sure, but that hasn't been the binding constraint for years. The binding constraint is that a compliance department cannot approve an asset nobody can legally classify. Think about what a pension fund actually is. It's a pool of other people's retirement money, governed by strict rules about what it can hold. Before it buys anything, somebody internally has to write down what the thing is, which regulator oversees it, and who is legally responsible if it goes wrong. For most of the crypto market, that document could not be written. Not because the answer was bad, but because there wasn't one. Classification makes custody possible. Custody makes allocation possible. And allocation is the money. That's why the head of one policy institute described asset allocators as actively exploring crypto exposure while withholding actual capital, waiting on defined rules. The interest was already there, the paperwork wasn't. There's a second reason statute matters. In March this year, the SEC and CFTC jointly issued guidance classifying 16 digital assets. Useful, but it's guidance, and a future administration could reverse it with a memo. Institutions aren't investing on the current administration's mood, they're investing on what survives the next one. And the scale is the point. Pension funds, insurance companies, and sovereign wealth funds manage tens of trillions between them. Nobody sensible thinks most of that is heading into crypto, but these pools are so large that a rounding error is enormous. 1 percentage point from institutions currently holding nothing would be more money than most of the token market is worth today. That's the arithmetic behind the excitement. All of that is the institutional picture, but most people watching this aren't a pension fund. So what might actually change for someone holding a few £1,000s or dollars of crypto on an app on their phone? A few things, and I want to be careful here because anyone telling you they know exactly what happens next is guessing with confidence. The first is what your exchange is allowed to offer you. Platforms currently make listing decisions partly on legal risk, not whether an asset is good, but whether offering it might get them sued. If classification becomes law, that calculation changes, and some assets and products currently unavailable may come back. The second is the boring one that matters most: your platform's odds of surviving. Every exchange you use has operated with a legal question mark over it. Statutory rules replace that with a rule book. Boring is the point. You want the company holding your money to be boring. The third is stablecoins, which get their own defined category, which may mean fewer surprises about what's actually backing the one you park money in. And then there's the question everyone actually wants answered: what happens to the price? Nobody knows. Genuinely nobody. Not the analysts, not the senators, and certainly not me. What can be said is roughly this: Bitcoin sits around 50% below its October 2025 high, and sentiment has spent much of this year in what the fear and greed indices class as extreme fear. JP Morgan analysts have described potential passage as a positive catalyst. Others expect a short-lived pop followed by a slower tailwind as institutions onboard, rather than anything dramatic overnight. But there's a catch. Markets price expectations, not events. Crypto has already moved repeatedly on this bill's odds alone. Up when passage looked likely, down when talks collapsed. So some of the good news may already be sitting in today's price. If it passes, the reaction could be smaller than people expect. If it fails, the disappointment could be larger. A catalyst is not a guarantee, and none of this is advice about what you should do with your money. So if the bill fixes a decade-old problem, passed the House with bipartisan support, and has the industry, several regulators, and the White House behind it, why has it been stuck for a year? There are a few things holding it up, but one of them has dominated everything else, and it has almost nothing to do with crypto. It's an ethics provision. In plain terms, a rule barring the president, the vice president, members of Congress, and other senior officials from profiting from digital asset businesses while they're in office. Now, you might reasonably assume that's already illegal. It mostly is. Federal conflict of interest law bars executive branch officials from working on matters affecting their own finances, and it's a criminal statute with real teeth. But it contains one explicit exemption. The president and the vice president aren't covered by it. That exemption is deliberate and decades old, rooted in the constitutional position of the presidency. Most presidents since Jimmy Carter have handled the gap voluntarily using blind trusts. But as written, nothing stops a sitting president signing crypto legislation while holding a personal crypto fortune, which matters here because President Trump's financial disclosure put his crypto-related income for 2025 at more than $1.4 billion, primarily from the Trump meme coin and from World Liberty Financial, a crypto venture linked to his family. So, Senate Democrats made the ethics provision their price. Several have said publicly they won't vote for the bill without it, and their votes aren't optional. Republicans hold 53 Senate seats. At least 2 Republicans are expected to vote no on other grounds. And clearing a filibuster takes 60. Roughly 7 Democrats have to cross over. The White House position has been that it will accept ethics rules applying uniformly across government, from the president down to the newest intern, but will reject language that singles out any specific person or family. Democrats want language with teeth aimed at the actual conflict. The White House wants language that doesn't name anyone. That gap, uniform rules versus targeted restrictions, is where the whole thing has been sitting for months. One draft ran to 309 pages and contained zero conflict of interest provisions, which Democrats called a deal breaker. A later merged version grew by more than 70 pages and still left the clause out. Hundreds of pages of detail about custody, disclosure, and market structure, and the missing piece was a paragraph about who's allowed to own what. And notice what's unusual here. This isn't a fight about whether crypto should be regulated. Both sides broadly agree it should. It's a fight about who gets to benefit from the regulating. And to be fair, ethics isn't the only thing on the table. There's a second fight over a legal shield for DeFi developers. The idea that someone who writes code but never touches customer money shouldn't be regulated like a bank. Police groups have pushed back hard, arguing it would make financial crime harder to prosecute. And there's a third, quieter fight over whether platforms can keep paying you rewards on stablecoin holdings, a question worth around $1.35 billion a year to Coinbase alone, with the banking industry lobbying against it. What's striking is that all three fights are the same argument in different clothes. Each one is about who gets an exemption from the new rules: a president's holdings, published code, platform rewards. And exemptions are where legislation quietly decides who wins. Reports in recent days suggest a compromise on the ethics language may finally be close, with draft text circulating among senators. But at the time of recording, Democrats had not publicly signed off on it, and the White House had not formally confirmed the details. Treat it as movement, not a conclusion. Here's what makes this urgent rather than merely interesting. The Senate breaks for its summer recess in early August. After that, the calendar belongs to the midterm elections, and legislation involving a president's personal finances does not get easier in an election year. That leaves a window measured in weeks, not months. Senator Cynthia Lummis, who has spent roughly 10 months on this bill, has warned that if it doesn't clear Congress before the midterms, it may not get another serious chance for years. One estimate puts the next realistic window as far out as 2030. That's not hypothetical. The last serious attempt passed the House in May 2024 and then died quietly in the Senate without a vote. If it fails, nothing collapses on day one. The industry simply goes back to where it was. Operating under agency guidance, any future administration can withdraw with a memo and enforcement that tells you the rules only after you've broken them. And that's the argument for why a statute matters more than goodwill. A memo is written in pencil. A law is written in ink. Right now, the entire regulatory position of a market worth trillions of dollars is a pencil sketch, and every institution looking at it knows that. Goodwill has an expiry date. It expires at the next election. For 10 years, the complaint from inside the crypto industry was the same. Nobody will tell us what the rules are. Somebody finally has. 594 pages of them.